This is the sixth meeting of the FOMC. It's done, Tim.
It is done. And we just wrapped up listening to Fed Chair Jay Powell talking about the decision and the economy and what's to come. Well, you know what, Carol?
What?
The Fed leaves rates unchanged, signals one more rate hike this year. Powell says central bank to proceed carefully on a rate path.
Carefully. How many times? It was like a drinking game. Every time he said careful or carefully.
I hope you weren't drinking during that.
Well, maybe some water.
You would be drinking a lot. And then 2-year Treasury yields, they went flat after that initial surge.
Unbelievable. All right, so let's get to it. I will say the Fed chief saying that there's so much uncertainty around the timing of rate cuts. And that was something I felt like in the press conference that reporters were trying to pin him down to, and he would not be pinned, although it does feel like higher for longer. All right, so let's get to it. Let's get some analysis because we did get an an update on those economic projections from the Federal Reserve. And that was certainly something we were all focused on. What we have with us, or who we have with us, a former Bloomberg colleague, Yelena Shaletyeva, senior U.S. economist at BNP Paribas on Zoom in New York City, and then Bloomberg Economics U.S. economist Stuart Paul. He's here in our Bloomberg Interactive Broker studio. Stuart, I do want to start with you. What are or were the key points of today's decision and what Jay Powell chose to stress in that press conference?
So Powell is definitely stressing that he's going to be maintaining a higher for longer posture. I think that some of the confusion that came from the press conference is that this is just a generally hawkish summary of economic projections. That's really the content of today's FOMC decision, is the summary of economic projections showing far fewer cuts in 2024, more optimistic GDP growth path. But for some reason, Powell, when he took to the podium, said that a soft landing is not his base case. It's almost as
though... What does that mean?
I was very surprised to hear that.
So what does that mean? That means things are better?
No,
Tim?
I mean, I took it as bad news. I took it as, things aren't as good as people think.
Well, we here at Bloomberg Economics think that there is some softness underneath the surface. I think that if we're trying to analyze the intent of the Fed chairman here, we have to think that he's trying to invoke some sort of a memory of Volcker, which is that he's willing to do what's necessary to break the back of inflation. Yes, he's optimistic about growth. That's why the median member of the FOMC at least is optimistic about growth. That's what helps to explain the median projection for the Fed funds rate, maintaining that higher for longer posture, ending 2024 at 5.1%, the 5 to 5.25 range. And if the Fed is ever going to have to rein in inflation, maybe something might have to crack. That's what I think that he was alluding to when he says that a soft landing isn't necessarily his base case.
And Bloomberg Economics' Anna Wong writing, officials also completely scrapped a recession forecast for this year. Right. So definitely taking that off the table. Hey,
Yelena Shaletyeva, come on in here. Senior U.S. economist at BNP Paribas, also our former colleague here at Bloomberg. Yelena, how did you read into that comment from Fed Chair Jay Powell? He would not call this soft landing a baseline expectation. What's your interpretation of that?
I think the chair is alluding to some event risk here. And I think there is a lot of things that could go wrong from now on. Yes, the economic growth looks really strong if you look at the recent data, but we have a confluence of significant negative risks coming all at the same time in the fourth quarter of this year. You have student loan repayments restart. You have a possible shutdown, excess savings are depleting. So there are significant risks to the soft landing scenario that is reflected in the summary of economic projections. They're really seeing a stronger growth, lower unemployment rate, and at the same time, much lower inflation. I think the event risks that will make them be cautious at the following meeting.
If you could have asked a question to the Fed chair, Yelena, what would it have been?
I think I wanted to hear a much clearer explanation of what he thinks about policy legs. He alluded to that a little bit in the opening remarks, but the extent of how much previous policy tightening impacted economic growth, I would like to get a better sense of that. It seems like Chair himself believes that policy legs have not fully percolated through the economy and more impact is coming.
Well, and Stuart, I want to ask you, process of getting inflation to 2% has a long way to go. So do I read that as, yep, we're not at 2% yet, so we get that, Chair Powell, or is it that also means you guys still have work to do? And so cool your jets, everybody who's thinking of Fed cuts.
The projected path for the Fed funds rate target range, at least for the median voter on the FOMC, seems to be almost separate and apart from the economic fundamentals that they're showing in their projections. We're not getting to the 2% core PCE target until 2026. So yes, the core PCE forecast was modestly revised down for 2023, but we also see growth being revised up. We see unemployment being revised down, labor market staying tighter for longer. That's not the higher for longer, the tighter for longer that the Fed had been looking for, right? So do those fundamental economic projections, those forecasts, scream one more rate hike to you? I mean, it seems as though, to Yelena's point, that maybe these optimistic projections are just that. Maybe they're just a little bit of a wish and something will crack in the background. Maybe it's something fundamental like Yelena was talking about that we've written about extensively. Maybe it's something like liquidity, and we haven't heard anything about QT in multiple press conferences.
Well, Yelena, Stuart raises a really good point. I mean, how seriously can you take the dot plot out 2 years? It's one thing to, take the dot plot projections out for the remainder of the year, but it's an entirely different thing to look at it for the end of 2025. How do you look at different times there versus what they're saying?
I think you really have to take it with a grain of salt, even going into the next year. We did notice that the range of projections for 2024 narrowed, but it's still a very wide range of totally different projections. And even this year, I think the fact that the Fed downgraded inflation projections, but they are still, I think, in our view, very high relative to what will likely happen. So in this sense, if inflation surprises to the downside closer to the end of the year, that will give them a way out of the last projected hike of the cycle. We think that they have reached the terminal rate.
Is there a word that you seize on in terms of what came out of Jay Powell's mouth today, Yelena?
In a sense,
is there a word that just sometimes he uses a word over and over. Sometimes there's a phrase, and we all kind of, that's in the headlines.
It used to be transitory.
It used to be transitory, data dependent, right? How many times have we said that? Is there anything that came out of his mouth that you thought, okay, this is kind of where this
data dependency? But that has been their mantra for quite some time. I think that they just want to be cautious with those, sticky words.
How about for you, Stuart? Was there something there?
No, the thing that really stood out to me was that Jay Powell didn't seem to strike, at least not to me, a single hawkish or dovish tone. Usually, at least over the past few years, when the FOMC makes a decision, so in this case, to hold rates steady, he'll end up striking a more hawkish tone to compensate for the pause in rates. Or if they were to hike, he ends up coming out a little bit dovish during the press conference to sort of tone down any sort of market reaction to the actual decision itself. That was not the case today during the press conference, at least not to my ear.
What did you hear?
To my ear, he sounded a little bit cautious. He used the word cautious multiple times. And they were just the same way that we see this sort of break between the FOMC's median forecast for the funds rate itself and its forecast for the economic projections. It seems that there wasn't a cohesive narrative, at least not to me, when I was listening to the press conference.
It's interesting, right?
Totally. Stuart's point, if I may,
please.
There's a lot of risk management approach in what they're doing right now. Not that they have achieved the goal, but they're very cautiously moving along. It's risk management that is driving their decision at the point.
All right. So, okay, where do we go from here? And I guess it's, Yelena, what are the next kind of focal points for you? Is it just we're going to go from data point to data point? I mean, how do you think about November?
So we only get one more CPI report and one more payrolls report before the November meeting. So, I mean, they are saying they're data dependent, but there's really not that much data that they're going to get. I think what will keep them on hold at the next meeting is really the event risk. So again, I mentioned a lot of things that are coming that could influence their decision to be even more cautious in the near term. But I think by the time they get to the end of the year, to the December meeting, we will probably get a lot of data showing a significant slowdown in economic growth, and even further slowdown in the labor market. And eventually that would stop them from going another time, as they are projecting in the summary of economic projections.
Stuart, I like the way that Yelena described event risk, these things that we talk about that the Fed absolutely has no control over. Something that Jay Powell said, higher oil prices,
sure.
UAW strikes, student loan payments starting up once again. What's the biggest event risk on your radar right now?
I'm not sure this is entirely an event itself. It is a catalyst that's starting, but it's well signaled, right? We know that student loan repayments are going to be starting. In fact, student borrowers have started those repayments already, and flows into the Department of Education's coffers within the Treasury have already reached pre-pandemic flows. So that should, based on typical flows into the Department of Education, shave off something like 50 basis points from PCE spending on a monthly basis. I think that's what's biggest to me. Other things like the UAW strike, imagine that's temporary, shave something like 1 percentage point off of industrial production. That's the sort of thing that you get back, though, when they fire up the assembly lines again. Same thing goes with the government shutdown. We would not even see that show up in the establishment survey if any sort of federal agency still keeps workers on its payrolls, at least insofar as those workers will receive back pay when they are brought back to work. At the end of a shutdown, even a government shutdown wouldn't hurt non-farm payroll growth that much. But the extent of, the Board of Governors is sitting there on Constitution Avenue. It's the sort of thing that they would see firsthand when economic activity within the district slows to a halt during a government shutdown. So it's the sort of thing that can feel very scary to policymakers.
Right. I always think about with these kind of things, it's either kind of a one-off if it ends quickly.
Right.
The longer these things lag on, I assume the economic impact is so much greater. Yelena, it was kind of fun, I guess, to kind of watch Jay Powell deal with, trying to be pressured into, when do we cut rates? When does it come? He says going into 2024, the time will come at some point, and I'm not saying when, to cut interest rates. So he's very careful about that. How do you think about when we will start to cut rates?
So in our view, we will slip into a recession, and that will be a modest recession in our view, but still that should push the Fed to start cutting rates. Another consideration is something that came up during the press conference is the level of real rates. So right. If inflation continues to slow down and it falls rapidly, that would push real rates much higher from where they are right now. They are already in a restrictive territory, and the Fed will just not want to keep pushing real rates even higher into the restrictive policy stance. So at some point, the Fed will have to cut nominal rates just to keep real rates from rising further. So, and we think that that time will come sometime in the middle of next year.
You have any thoughts on that?
No, I think that's generally right. I think it's in the middle of next year. I wouldn't be surprised to see something like 25 basis points a meeting starting from June, July. And it's exactly that. It's to maintain that constant spread between printed inflation and nominal policy rates, so that monetary policy stays sufficiently restrictive but not excessively restrictive. I think that just, Tim, to your question earlier, thinking about any sort of catalyst that could be shocking, that could materially change policy decisions. It seems as though people have entirely stopped discussing liquidity, and they've entirely stopped discussing the consequences of QT. But the Bank Term Funding Program has maintained essentially a constant balance. Banks are still continuing to borrow from the Federal Home Loan Banks, and we're still seeing deposits leaving the banking system because rates are materially higher.
You're talking about the fallout from the regional bank crisis?
Well, even preceding the regional bank crisis, as a consequence of quantitative tightening, the other aspect of monetary policy that's operating just sort of in the background, there is an attempt to soak up liquidity at the Fed. And though we always focus on the Fed's dual mandate, price stability and full employment or maximum employment, the sort of thing that could pop up in the background is a liquidity event. And those sort of events tend to be pretty convex. We don't really have the foresight of saying, student loan payments are starting in October again. They happen when they happen, and I'm surprised that it's the sort of thing that doesn't come up in press conferences anymore.
I mean, COVID happened when it happened. March 2020 happened when it happened. These are things that, if you go back to 2019 and the summary of economic projections then,
right,
nobody was foreseeing something like this, an event risk like this, causing the Fed to drop rates to zero.
No, exactly. I mean, I don't know. I mean, you think about this year, Yelena, and I feel like we've been all over the map, right? When it comes to, we thought kind of the world was coming to an end, mini end, with the regional bank crisis. But, we've dealt with crypto over the last year. I mean, there's been a lot of things that have certainly come at this market. But, here we have an environment where you see certainly equity strategists continuing just to kind of ratchet their estimates higher. But at the same time, I'm looking at, and stocks right now are down to their lows of the session, but I'm looking at, the rate moves today. Your 2-year at 5.14, 10-year at 4.3. I mean, 5-year at 4.53. I mean, are these the rates that we should anticipate we'll continue to see, certainly going into 2024?
Well, at some point, the Fed will have to cut rates, and we will see some movement on that front.
Right.
I think one thing I would like to highlight, though, is all these things that we mentioned in our discussion, like such as student loans and strikes and, the depletion of excess savings. We should not forget about that, even though we've been talking about it for a long time. Those things make the economy more vulnerable to exogenous shocks. So some type of liquidity events and other things that Stuart mentioned. So, I think that the slowdown in the economy to the point at which it approaches somewhat some stall speed, that makes the economy really vulnerable to something that could happen that we cannot anticipate. And that's an important point. And this is something that we should be watching.
Yeah. I mean, there's a lot on the plate. Certainly a lot covered by Jay Powell today, but a lot for us to kind of continue to mull over, and we'll see how the financial markets continue to read it. Guys, thank you so much. Really appreciate it. I know you guys have had a busy afternoon watching all of this. So great to get your insight.
Stuart was here late last night. I saw you on TV late last night.
What
when we were getting out.
Are we doing a preview?
Australia daybreak.
Oh, yeah. Well, I mean, somebody's got to do it.
A lot of central banks right now, right? Making moves.
Somebody needs to talk about starts and permits. Somebody needs to talk about what to anticipate from the Fed. So it's been a busy day for us. Yelena, we miss you here at Bloomberg. Eliza says hello.
We do miss
all
her.
the best over there.
I miss you guys too.
Well, you know what? We love it when you get to join us, Yelena, and on Fed Day and anytime. So it's awesome to have you back with us.
Totally. All right, be well. Yelena Shaletyeva, senior U.S. economist at BNP Paribas, as you know, a former Bloomberg colleague, and Stuart Paul, U.S. economist at Bloomberg Economics.
This is the Bloomberg Business Week podcast, available on Apple, Spotify, and anywhere else you get your podcasts. Listen live weekday afternoons from 3 to 6 Eastern on Bloomberg.com, the iHeartRadio app, TuneIn, and the Bloomberg Business app. You can also watch us live every weekday on YouTube and always on the Bloomberg Terminal.